Let's talk about a day that absolutely rocked Wall Street. What started out as a totally calm, confident day ended in a complete and total rout. So we're going to dive in and unpack exactly what caused this sudden shock.
So let's set the scene. The date is Friday, October 10th, 2025. Markets were just kind of chilling, hovering near all-time highs. Honestly, there was zero indication of the historic downturn that was about to hit.
And then, bam! The S&P 500 plunged 2.71%. That was its worst single-day drop since way back in April. It literally wiped out weeks of gains in just a few hours.
But if you thought that was bad, the tech sector felt the pain even more. The Nasdaq Composite just got hammered, plummeting over 820 points. That's a staggering 3.56% loss. Ouch.
And look, this sell-off was everywhere. Even the Dow, which is usually a bit more stable, fell over 878 points, a drop of 1.9%. It just goes to show you that absolutely no corner of the market was safe.
So what on earth could cause such a violent, sudden reversal, right? It wasn't some bad economic report. It wasn't a surprise from the Fed. Nope. It all came down to a single social media post.
Okay, let's get right to it. Let's pinpoint the exact catalyst that turned a quiet Friday morning into a full-blown market panic.
And there it is, a threat to slap a new, massive 100% tariff on Chinese goods. And as if that wasn't enough, there was a hint that an upcoming meeting with President Xi might get canceled. Just like that, the ghost of the trade war was back, and with a vengeance. This timeline here, it shows you the day's drama perfectly. The market opened up a little bit, but then at 10:57 a.m., that's when the announcement hit, and the bottom just completely fell out. The selling was relentless, and all the dip buyers, the folks who usually jump in on weakness, they were nowhere to be seen. That's why we closed right near the day's lows.
Now, this threat didn't just happen in a vacuum. The market was already a bit on edge because of a 10-day government shutdown. But maybe more importantly, there was this sense of complacency, this belief that major trade fights were a thing of the past. Well, that idea was shattered.
Okay, so now let's dig into how this shockwave hit specific sectors and companies. When all the dust settled, who were the biggest winners and, well, the biggest losers?
This chart tells the whole story. You can see the information technology sector was basically ground zero for the sell-off, dropping almost 4% as investors started freaking out about supply chains. But then, look closely on the other side. You see that one tiny little sliver of green? That's consumer staples. Yeah, defensive stocks like Coke and Pepsi actually went up a tiny bit as investors ran for safety.
Speaking of tech, let's look at NVIDIA. It fell almost 5%. As a huge player in AI and semiconductors, it is incredibly sensitive to this kind of geopolitical risk. Any threat of Chinese export controls makes it a bellwether for the entire tech sell-off.
Qualcomm also took a serious hit, dropping around 3%. For them, it was even more direct. On the very same day, China announced it was launching an antitrust probe into one of their acquisitions. You can't get a clearer signal than that of escalating U.S.-China tensions hitting individual companies. But amidst all that wreckage, Applied Digital was a fascinating outlier. It surged over 16%. So why? Well, they reported strong earnings and announced they were in talks for a massive new data center contract. It's a great reminder that despite all the geopolitical drama, the underlying demand for AI infrastructure is still incredibly strong. The tariff fears got very, very real with Levi's. The stock plunged over 7%. And here's why. Even though they raised their guidance, their CEO explicitly warned on the earnings call that tariffs were already starting to hurt their profit margins. That's what made the threat feel immediate and concrete for everybody.
And finally, on the flip side, you have MP Materials, which jumped over 8%. It's a major US-based producer of rare earth metals, and investors immediately saw its strategic value. If China retaliates by restricting its own rare earth exports, a company like MP Materials becomes a critical national asset.
So after a day like that, the million-dollar question is, what now? What do you do? Let's explore 3 distinct paths an investor might consider taking from here.
We can really frame the options as 3 core strategies. First, there's the aggressive play, where you're betting on a quick, V-shaped rebound. Second, a more selective approach, focusing on that durable AI trend. And third, a defensive stance, where your number one priority is just preserving your capital.
This table breaks it all down. For the aggressive rebound, you might look at something like TQQQ,
a leveraged ETF that tries to triple the Nasdaq's daily return. You're betting this is all just a negotiation tactic. The big risk? The tariffs are real. Then there's the selective AI bet. Maybe you use a utilities ETF like XLU to invest in the companies powering all those data centers. You're banking on AI's long-term growth, but the risk is high valuations. And finally, the defensive stand. Think a gold ETF like GLD. You're protecting your capital, but the risk is you might miss out on a sharp rebound if all these fears are overblown.
Okay, let's zoom out for a second and put this entire chaotic day into perspective. What are the most important takeaways for understanding where the market is right now?
So what we have here is a really clear conflict for investors. On the one hand, the huge negative is this 100% tariff threat, which just injected extreme geopolitical risk back into the system. But on the other hand, the most positive sign was Fed Governor Christopher Waller signaling he supports 2 more rate cuts. So while geopolitical risk is way up, the promise of the Fed support is still there.
Looking ahead, 2 immediate risks really stand out. First is the potential for a final flush on Monday. That's where automated trading systems could trigger a wave of forced selling. The second, and much bigger risk, is that this 100% tariff threat isn't a bluff, that it becomes a long-term reality and fundamentally damages corporate profits.
And all of this brings us to the ultimate question every single investor is facing right now. Was Friday's panic selling a golden opportunity to buy stocks at a discount? Or is it a warning shot, a sign of much deeper cracks forming in the foundation of the global economy? The answer to that is going to define where the market goes from here.